Hello and welcome to episode 469 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good. It's been quite an exciting week in the world of money because the Bank of England cut the base rate. So we went from the historic, the 16-year high of 5.25% to 5%. So it's going to be a bit of a focal point for this week's podcast, and it causes a lot of work for us at Money to the Masses because we have to go and change lots of things on the website, lots of articles that reference the Bank of England base rate. So I think most listeners will be wondering what the impact is of that. So I'm actually telling you what's going to be on the show effectively, so I might as well just continue on that thread. I'm going to do a piece obviously about the Bank of England base rate cut and what it means for savers and borrowers and what people should be really doing right now, and also the projections of where it's going to be, particularly later this year. But then I'm going to do a special investing piece which looks at what could potentially happen for investment markets. So I'm talking about assets and sectors. I did a piece of research for 80/20 investor members that looks at this next phase in the interest rate cycle as we're moving from the pause phase after the rate hikes that we've seen into this new rate cutting cycle. What does that mean for your portfolio and how can you potentially take advantage? And also looking where the smart money is betting or placing their money. So I'm going to give you insights into that. And the final piece on the podcast, Andy, you're going to be doing a piece on scams, or a particular type of scam.
Yeah, so right at the end of the podcast, we'll do a very quick piece on a very sophisticated scam that's becoming more and more popular. It's on the rise, something to look out for. It's one of the few scams that actually I feel like I could easily fall foul of, because it's kind of got a bit of a tech element to it, but it also can easily sort of dig into your finances and very easily steal your data. So we'll cover that at the end of the show.
And I think the victim that went public on this one, didn't they lose their life savings as a result?
Yeah, absolutely. And I looked at it and I thought, do you know what? That's one that possibly even I could have fallen foul of. So it piqued my interest and I thought I've got to mention it on the pod.
Yeah, so anybody can fall foul of a scam. So it's important that we bring it to the podcast. So I'm going to go straight into the first piece on the podcast, which is in relation to that interest rate cut. So just to remind everybody, the Bank of England base rate was at 5.25%, which was a 16-year high, and that had been increased over a period of time from an historic low after the pandemic where we got down to 0.1%, and that was increased to 5.25% over a period of time. Then we've been at 5.25%, or we had been, for a year. So last August was the last hike. We got through to this August, and the Bank of England cut the base rate by 0.25%. So we're now at this 5% rate. Now, the Bank of England base rate has a huge impact on not only the economy, but also things like savings rates and also mortgage rates. Now, the rate cut was expected to a point. So as we headed towards the rate decision on Thursday, the odds that were being placed by analysts. So if you looked at what the analysts were predicting, how many of them thought there would be a cut, how many thought there would be a hold in the base rate, roughly there was about a 60% chance that there was going to be a rate cut. Now, we actually got that rate cut, and I think it surprised quite a few people, and that therefore rippled through markets, and it has had an impact on where markets and investors are betting that rates will go in the future. It's not significant, but it has had a minor impact. Now, just to remind people, the way the Bank of England sets the base rate, they have a monetary policy committee. So it's a 9-strong person committee, and it's a majority vote. So they can vote to keep the base rate the same, cut it, or increase it. And in this instance, we had a majority vote. It was very, very close, actually. It was only marginal by one vote that we had a rate cut. So that just shows you where we are in the balance at the moment. Now, Andrew Bailey, who's the Bank of England governor, came out afterwards, and they always do a press conference and do some sound bites or interviews with the press. And in those interviews, he said that we should be cautious about predicting the next base rate. So I'm paraphrasing slightly, but basically we shouldn't expect a sudden flurry of rate cuts or aggressive rate cuts, because we normally only see those aggressive cuts following a crisis of some kind. So the pandemic, for example, or the financial crisis, we saw aggressive rate cuts. So where is the market predicting that the base rate will be in the future? Well, they are penciling in one or possibly two more rate cuts before the end of this year. So we have moved into that rate cutting cycle. I think people need to be cautious about how soon we'll see that filter into the mortgage market. So just to give people an update what's been going on with the mortgage market, you will have seen headlines saying that rates have been tumbling. So I'm talking about mortgage rates here. But when you dig beneath those headlines, we've actually seen the cut on the 5-year fixes. The 2-year fixed rate market has been fairly stable in recent months. We've seen a little bit of volatility. We've been hanging around about that 4.3% level for a 2-year fixed rate mortgage. So I'm talking about 60% loan to value on that one. So they were the best rates. Will we get below 4% soon? Possibly, but I think some of that rate cut that we had in August has already been baked into the mortgage market. The 5-year fixes, yes, we could still see those come down slightly. So I don't think we're going to see an immediate reaction, but I think it's obviously positive for mortgage holders and people who are going to be remortgaging in the future that we have moved into that rate cutting cycle.
Yeah, and Damien, it's probably just quickly worth mentioning what this means for those on a variable rate mortgage. So the 0.25% cut equates to roughly £13 per month for every £100,000 of mortgage, and that's based on a 25-year term. So let's say you had a £200,000 mortgage and you're on a variable rate, that is going to save you roughly £26 per month. And so what about savers then?
I think for savers, the big thing is that you are going to start seeing savings rates fall. And the reason that I'm very confident in that is because historically what's happened is that banks and building societies are very slow to pass on rate cuts when it comes to mortgages, so when you're borrowing money from them, but they're very quick to do so when it comes to savings accounts and the interest that they pay you. And within, I think it was, Andy, not even 2 hours, we were receiving emails from certain banks and building societies to say that they were already starting to cut interest rates. So the message to people who listen to this podcast is, if you're a saver, then if you were planning on putting money aside and trying to get the best savings rate, you need to act now, because rates are going to probably start coming down a little bit faster than they have been now that we've entered this rate cutting cycle, because we've already seen it happen within hours of the Bank of England decision. Obviously, mortgage borrowers, if you are due to remortgage, then you want to obviously speak to a mortgage advisor. That's always my advice, because they can find you not only the best deal, but one that you can actually apply for. But you'll also probably be attracted to tracker rate mortgages. They're going to be in the equation now when you're looking at what type of mortgage that you want to get. Now, if you look at the market predictions beyond this year, they are still roughly where they were prior to the rate cut. I think we're going to be looking at about 3.5% by the beginning of 2027. One thing we do have to bear in mind is that the Bank of England has warned that inflation is likely to pick up as we head into the latter part of this year. So we could see inflation heading back towards 3%, which isn't a problem in itself as long as that obviously stops rising. Don't forget the Bank of England target for inflation is 2%, but they have that wiggle room of 1% either side. If they go beyond that, so if it went above 3%, they'd have to write a letter and explain to the Chancellor what is going on. So we've got that in the autumn, but we've also got Labour's budget on the 30th of October. So that date has now been set, and that has the potential to obviously have a huge impact on the economy and also inflation, because if the Labour government was to announce lots of government spending, then that can be inflationary. So we've got to see what happens. So the projections that we've got now for where the Bank of England base rate could be don't take into account anything about in relation to the plans by the Labour government, because they're unknown at the moment. So that gives everybody a bit of a summary of what's gone on with the Bank of England base rate this week and the predictions of where they will be. It's good news for people who have mortgages. I don't think they should get overly excited just yet and pop the champagne corks, but it's obviously moving in the right direction. But for people who are savers, then they may need to take action, and they will have to probably shop around a bit more and possibly lock their money away if they can in fixed term deposits if they want to get the best savings rates. But one thing to point out is, obviously at Money to the Masses, we update a weekly summary of the best savings rates in the market, but also the best mortgage rates. We'll put links to those in the notes of this podcast so people can go through, bookmark them, and they can reference them going forward into the future.
Okay, so on the similar theme then, we're talking about rate cuts, the recent rate cut. Damien, you've done a bit of research for 80/20 investor members on where the smart money is. What does this rate cut mean for investors?
Yeah, so if we go back a year ago, I carried out a piece of research that looked at the impact of the interest rate cycle and moving from one phase to another. So by that I mean the phases of aggressive rate hikes, which we had, the period of rate pauses, which we've had over the last year, and then a period of rate cuts, which we look like we might be entering into now. And as you move through each of those cycles, because of the implications for the wider economy and the reasons why the Bank of England is actually changing its monetary policy, there are certain assets and parts of the market in terms of equities that tend to outperform or underperform during those parts of the interest rate cycle. So the original piece of research looked at historic rate cycle periods and then looked how the different assets and particular parts of the equity market performed in each of those three different phases of the interest rate cycle. And looking at the research that I carried out last year, for 80/20 investor members, I went back and said, well, how did the lessons of history, how accurate were they in predicting what occurred over the last year and which assets and parts of the stock market would be the winners and losers? Now, obviously, history is not going to give you any certainties, and there were things that did hold true for the pause phase of the Bank of England interest rate cycle, but there were also things that didn't actually hold true. So I'm going to run through a couple of those. So one of the best performing equity sectors was financial. So we're talking about bank stocks over the last year. And that's obviously because they tend to do well when rates have gone up and they remain high for a period of time, because it gives them the profit margin. So if you think about it, they can charge people more in terms of loans, but they won't necessarily pass on those rates in terms of the interest they pay on savings accounts, as I mentioned earlier in the podcast. That held true. We also saw other areas of the market that typically do well during a pause cycle perform quite well. There was European smaller companies did quite well. The UK equity income sector did quite well. But there were areas that didn't do well that you thought might do, and they were things like commodities, because that is typically, if you look at history, had done well because we are often in a period of high inflation. They didn't perform particularly well over the last year, and that will be partly because of the macro trends that went on. And one of those trends was that there was concern about the Chinese economy. So the Chinese economy obviously consumes huge amount of commodities. So if there's concern about the demand from the Chinese economy because of potentially slowing growth, then that tends to hit the demand for commodities, and so therefore commodity funds tend to underperform. We also saw obviously Chinese equities tend to underperform over the last year. So other areas of the market that actually performed better than expected was technology, and that was because the AI theme came into play. So obviously we've seen AI stocks, we've talked about Nvidia on the podcast, do particularly well, and that drove the technology sector ever higher, particularly obviously in the US. Now, what we learn from this is that the Bank of England base rate has an influence on the returns that we get as UK investors, but there are other wider macro themes that do dominate. So in this example, we have geopolitics, but we also have things like the AI theme that have been particularly strong in the last year, that have influenced markets. So it doesn't mean that you throw out all of the lessons of history, but what does it mean when you go forward into the next phase? Are there any trends that we should look out for? Well, one of the things that we should see potentially is that bonds start to perform that bit better on a relative basis, because if rates get cut, it makes the fixed payments that you often get on bonds more attractive, and therefore money flows into them, and therefore their price goes up, and bond funds therefore perform better. The other thing we're likely to see is the pound start to fall against other currencies. It does depend on those central banks' monetary policy decisions. So let's say, for example, the Fed, which hasn't cut rates yet, starts to aggressively cut rates, then that will impact that US dollar pound exchange rate. So at the moment, because the Bank of England has moved first, we saw the pound fall against the US dollar, for example, and that will have a positive boost to any US assets that you hold in your portfolio, maybe US equity funds. So we saw a little bit of that this week already. We tend to see technology stocks do a little bit better if we go into that rate cutting cycle. And obviously I'm focusing on the Bank of England, but we are starting to see central banks globally move into this rate cutting cycle. So the European Central Bank has already seen that occur. They cut rates already, and the Fed hasn't yet. But they've had a press conference recently and a monetary policy decision this week where although they held their interest rates, there was a hint that the rate cuts might come in the autumn. So we are looking like we're moving into that new phase. Now, of course, as I've said, you can't always rely on history for the answers as to what will do well in the next phase of the rate cutting cycles in different countries. But if you want to see which assets are likely to perform the best, then do have a look at the research on 80/20 Investor. But one thing I did do was go and look at what the smart money is doing. And when I say smart money, I'm talking about professional fund managers in the UK, North America, and of course Europe, because all of those managers are having to take into account the fact that we're moving into this new phase of the interest rate cycle, but also those other macro themes that do tend to overpower occasionally the monetary policy of central banks. That obviously has a huge influence on markets, but you do have these other macro themes, like I've mentioned, geopolitics or AI stocks, that are starting to influence markets. A very good example is political turmoil in France had a negative impact on European equities. So managers are having to take into account all of that. Now, of course, professional fund managers don't get it right all of the time, and they don't always outperform the wider market. It does give insight into what they're thinking about in terms of monetary policy and its impact potentially on the market going forward in their respective economies, but also those wider macro themes that they have to bear in mind that might overpower or influence markets in the short term. So what I did is look at what the fund managers in the US, Europe and the UK, what stocks they're buying, what stocks they're selling en masse, and therefore look at the sectors and the geographies of those stocks and see, are there any insights that we can glean from that into sectors that might perform well given the macro setup that we've got in terms of monetary policy, but also those other themes that are out there in the background. So I'm going to give you some of the insights, but you can go and look at the full research. So you could see the top 10 most bought stocks by UK fund managers or American fund managers, for example, that they like, and the most sold ones that they're avoiding, which will give you insights anyway into individual stocks. If you go and look at the 80/20 Investor research, if you're not a member, you can obviously take out a free trial and see it that way. But you can also see more insights into the sectors as well. But I'm going to just give you a quick overview. In the US, at the moment, what we're seeing is that the belief in the AI theme is still alive and kicking. So technology stocks are still among some of the most bought stocks out there. I mean, rate cuts can be positive for technology stocks, but I think the AI theme generally, the enthusiasm for that is driving people to still buy AI type stocks. So if you look at the most bought stocks at the moment by US managers, 5 of the top 6 are actually technology stocks. We're also seeing managers start to buy the mid-cap stocks. They're actually buying some ETFs that expose them to US mid-caps, so some of the smaller companies than the really big ones that are usually popular, like the tech stocks. And that's because we're seeing some rotations out of some of those large stocks. I think that could be a sign that they are worried about the high valuations of some of these tech stocks. They're taking some profits and they're putting it into the other areas of the market, the areas that show value because they've actually underperformed or lagged the wider market over recent years. So we've seen that rotation into some smaller cap stocks. So that is evident if you look at the most bought and sold stocks in the US. We're seeing movements out of financials and the energy sector, consumer staples, and industrials and healthcare. So what we suggest is that maybe with the energy and the financial services, they are thinking, yep, we're moving into a world with lower inflation and obviously rate cuts. And the consumer staples element, we're rotating out of that. They're being maybe a little bit more optimistic. I hate the phrase cautiously optimistic, but it does show an element of cautious optimism, because they are also starting to buy as well in the most bought some other defensive stocks. So it's not just they're moving completely out defensive. There is a split more towards some of the consumer discretionary type stocks and some of the more growth stocks in the most bought, but there is still a mixture of some defensive sectors in there. Even though a lot of defensive stocks have been sold, there is this element that they aren't quite letting off the fireworks and the popping champagne corks. There is this idea they're not 100% certain about what's going to happen with the US economy, so there are elements of defensive stocks being bought. So that is also interesting. Now, if we look at UK stocks, the fund managers there, I think the insights you can gain from looking at the most bought stocks and the most sold stocks is quite mixed. It gives a slightly mixed picture, with defensive stocks making the list of most bought. We don't have the technology exposure in the UK quite like we do in the US, so there aren't a lot of technology stocks being bought, so we don't see that AI theme in the UK, but it's really a mixed bag, and I think that is a reflection of a lack of conviction of what's going to happen going forward. So when I talk about the most bought and most sold stocks, I'm talking about over the last 3 months in each instance. And of course that covers the UK election, so there was uncertainty around that. Although the outcome was widely expected, there was still some uncertainty in the stock market, but also it covers the period where inflation, there were concerns about whether inflation was falling or whether it was going to pick back up again. We've got a little bit more certainty about that now, so maybe going forward what we'll see is if we repeat this exercise in the future, we will start to see some more definitive movements. Maybe we'll see managers start going into areas of the market that are more cyclical. But at the moment, it's a bit of a mixed bag where fund managers are being cautious. If we jump to Europe, then there is a very distinct pattern in Europe, which is, again, very interesting. If you look at the most sold stocks, but you also look at not just the sectors, but the countries that they come from, France almost dominates all of the most sold stocks, and that's obviously because of that political turmoil that we've had in France, and it impacted the French stock market. We saw a lot of volatility and a lot of selling. So one of the things we've had is politics in Europe, and European fund managers have responded by selling French stocks. We've seen the European Central Bank cut interest rates, so therefore I think we've seen the uncertainty politically start to impact the banking sector, and obviously concerns over the future economic growth, but also that cut in interest rates and the prediction of further cuts start to impact that particular sector. The other thing I will say as well is that we've seen some luxury goods companies actually sold. So it starts to suggest that we are moving away from the luxury goods and consumer discretionary, and there are some sectors that are being bought, seeing money go into them, and they are things like healthcare and consumer staples. So there is again less optimism in Europe than there is in even the UK, but especially in the US. So they're buying and selling from the fund managers gives you this insight into where they think the respective economies are going to go and the macro themes. So in the US, a little bit more optimism. Don't forget we've got the US election coming up later in the year, so that could change and start to impact what they buy and sell. Don't forget we do have that Trump trade that I've talked about on the market update, so we might see that start to come into the most bought and sold stocks depending on what Trump says at any given moment. So very interesting bit of research. If you want to see the full thing, like I say, you could take out a free trial, but there is a distinct difference between the 3 different geographies. But going forward, we're moving into that new rate cutting cycle, so we could see a change to the winners and losers within your portfolio, and it'd be interesting to see how that plays out in the coming months and years.
Okay, so let's move on to the final piece of the podcast then, and I'm going to be talking about a particular scam which I became aware of. Funnily enough, I was off on holiday one day and I had daytime TV on, and I was actually watching a program called Rip Off Britain. I'm not sure if you've ever heard of that, Damien. It's Gloria Hunniford and a couple of other presenters, and they do a good job on simplifying the things that are happening out there in terms of people getting ripped off. And one of the particular things that they covered was this scam that I'm going to cover now, which is scam apps. So apps on your mobile phone. Now, this piqued my interest because while I consider myself pretty financially savvy and aware of various scams, for example, with my email, I have two-factor authentication. Any paperwork at home is always shredded. I've got one of those little things at home that you can. It's got like an ink pad, and you can put it over addresses to make sure that everything is secure. So I'm pretty watertight in terms of how we deal with things at home. But then I watched this program and I thought, there's my weakness. That's where I could potentially come undone, because I am very lax when it comes to downloading apps on my phone. And I don't know why, because if you actually think about it, an app that you download onto your mobile phone, you don't necessarily know exactly what that app is doing. There's lots of things in the background. Obviously, we're all now probably guilty of being a little bit lax in terms of the consent that we're giving. We're all used to going onto websites these days and just pressing that button that allows all the cookies. Certainly for me, if I'm in a rush, I'll click accept all. I'm pretty similar when it comes to apps. I'll pretty much press all the buttons that comes up on the screen just to get through and open that app and do what I need to do with that app, whether it be a game or whatever. So the particular apps that you need to be careful of in the App Store are what they call counterfeit apps. So these are apps that imitate legitimate apps and will usually carry out a fairly mundane task that you need sorting out. And it is for that reason that people become unstuck, because they would just look at it. Yep, that looks like the thing that I need. I need this thing done. I'll just accept it and I'll go and do what I need to do. It's free. It doesn't cost anything and it's going to get the task done. I'm thinking things like Word doc apps where you need to do some word processing, or you need to open up a Word doc or a PDF. A really good example is a PDF app that will open, read and edit PDFs. Now, there are official apps in the App Store from Adobe, which often cost money, and there are often lots of very similar looking apps which might come under what we're talking about here, which is a counterfeit app made to look like the real thing, but actually what it's doing in the background is it's harvesting your data and doing some very, very nasty things in the background of your phone. I'll give you some examples of the things that it can do. It can record your screen, it can record your keystrokes, so it can take all of your passwords. It can also go into your phone settings and stop you from deleting the app itself, so it can put some code in there that will actually disable the ability to disable the app. It will also stop you from restarting your phone in many cases, and often what it will do is do things overnight as well. So it's actually doing things on your phone while you're not even aware that it's doing it. And this particular example that I'm going to highlight, I saw on Rip Off Britain, was where a lady had downloaded an app. She needed a PDF reader and all looked fine. What was actually happening is, in the background, it was stealing all of her information and data. It was copying all of her passwords and gaining access to things like her banking apps. Now, rather cleverly, it wasn't doing any of this suspicious activity while she was still awake. It was set to do it while she was asleep, while her phone was on the side being charged up, and it was moving money from her bank account because it had all the information it needed to get in there, and it was moving that money into alternative bank accounts, in this case Revolut. And it was doing it in small transactions of under £1,000 because, again, the app knew the certain things it needed to do to get through the certain security. So over the course of a few weeks, small amounts of money were being moved across from a main bank account into a Revolut account. And once it was in the Revolut account, it was then going off to offshore accounts in different accounts and cryptocurrency. So this is just a reminder to be really careful about the apps that you download. Be really suspicious. Make sure that you check the reviews on the app that you are downloading. Make sure you double check what consent you're giving that app, and you can check by going into your phone, going into that app, and you'll usually be able to see exactly what information that app can gain access to. Make sure that you check that and ensure that you're comfortable and happy that that app is accessing what it needs to do what it needs to do. Damien, I mean, that's something that scared me when I saw it. I thought that is definitely something that I need to be careful of.
Yeah, and I think it's a good thing to bring to the podcast. I mean, it sometimes is so difficult because you've got to be vigilant, like you say, be suspicious. You can do the things that you suggest, look at the reviews. I think fundamentally, I think you need to go for official apps. If there's something that you want to use, like you said, it's a PDF reader, then it is usually possible to buy the official app. And even if you have to pay a small amount, then that might be worth it for the peace of mind, because you don't want to fall victim to something like this. Now, obviously, this kind of fraud is relatively rare, but it is a good reminder just to people out there. Apps can be an issue too. So we all look at things like phishing emails, other types of scam that we talked about in the past, but this is obviously an area that we've not mentioned, but it's something to be mindful of. So I think, Andy, that is the sort of thing that I think any of us could fall foul of, and particularly I think when people share the apps, because don't forget, a lot of people will sit there and can share a link and say, oh, I use this app and it's pretty good, it does what you want. I think you need to go and look at the app yourself and go and review what it does before you download it.
Yeah, just to quickly finish this piece off in terms of apps and app safety and scams, be careful of downloading VPN apps. Check that it's a legitimate app. I would probably make sure that you download an official app and even pay money for it, because ironically, these VPN apps are designed to effectively keep you secure and hide where you're logging on from. But criminals are using these apps to actually harvest your data. So just be really careful.
I mean, I think that's a good point, because one of the tips we often suggest to people is to use VPNs, particularly if you go away abroad or you're traveling anywhere, hotels, and you're using Wi-Fi networks. Make sure, like you say, Andy, you do use a reputable VPN app, and it will mean that you will have to likely pay for that app, but it is better to do that. Better to be safe than sorry. So that is it for this week on the podcast. As ever, do please leave us a glowing 5-star review. It really helps. We haven't had a review for the last couple of weeks. I think you must all be on holiday. You've been writing in and messaging me, particularly about my poor cat recently. So do cheer me up again and leave us a 5-star review. Don't forget, I always forget to actually mention, on a Monday we do put out a quiz on Instagram about the topics we discuss. It's a multiple choice quiz on our Instagram stories, 5 questions which you answer to see if you understood or remembered what went on the podcast this week. I have said that, Andy, and it's the first time in probably about 2-3 months that I forgot to actually do it this week. I was one of the only people in the office. All of you guys seem to be on holiday and I forgot to do it. But this week there will be a quiz, so make sure you check that out on Monday after the release of this podcast. As ever, do follow us on Instagram, TikTok. Do share, like everything that we do on there. YouTube, we're always doing new content, particularly in relation to the interest rate stuff. I'll be doing more stuff going forward, looking at mortgage rates and savings rates even more regularly now that we had an interest rate cut. Do join our Facebook group, facebook.com/groups/money to the masses. And I think, Andy, I've remembered to say pretty much everything. So if that's the case, then I think all that's left to be said is until next time.
Until next time.